Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Now, there's a growing dichotomy, if you will, between retail and institutional investors. Now, it's all about who is embracing complexity to a greater degree and trying to gain an edge, and who might not be. So joining me now for this conversation is Mike Akins, the founding partner of ETF Action, alongside Aga Kuplinska, the Senior Vice President of Product Development over at Tidal Financial Group, a platform that brings a lot of ETFs to life, so to speak. Thank you both very much for being here with us right now. I want to start, Mike, with you on this interesting storyline, because it's one that I think captures a little bit of my attention and just thematically about where the ETF business is going. And that is to say that there is this divide happening between those ETFs that people view as more traditional and straightforward, and many of the actively managed ones that are maybe income or defined outcome oriented, that have become much more complicated in how they generate their particular performance, and who's actually investing where. So take us through the research that you guys have done over at ETF Action with regard to that institutional retail trade and who's gravitating towards what types of products.
Yeah, so it's a really interesting, right? We've almost got 5,000 ETFs in the market, and over the last several years, we've seen a lot more actively managed strategies, as well as what I would consider non-traditional strategies, whether that be synthetic income or buffer strategies, or the growth of single stock ETFs, whether they're covered calls or leverage inverse. And I think to set the stage, you have to understand that, pretty steadily over the last, 5 years, the ETF market, ownership market. So right now it's $14 trillion in ETFs. About 60% of that can be tied back to quarterly 13F filings, which are tied to institutions, whether they're independent RIAs or large broker dealers like Morgan Stanley, Goldman Sachs, whatever it may be. And what we've seen is, if you look at the big box categories like equity, fixed income, specifically, if you look at the big, large, passively managed strategies or broad-based strategies in those categories, it tends to be 60 to 70% institutional ownership. But as we look at that non-traditional category and watch it grow over the last 3 years, there's $170 billion in synthetic income ETFs, almost $100 billion in buffer ETFs. That number is significantly lower for most categories. So synthetic income, as an example, about 30 to 35% can be tied back to these 13F filings. But there are caveats. Buffer ETFs, which are more about downside protection, reducing some of your upside capture, but in return providing a buffer to the downside, those tend to be very heavily owned by the investment advisors that are using them for their client base.
All right, so with that in mind, Aga, it's interesting because over at Tidal Financial, your firm has become a launching kind of mechanism for many of the ETFs that are being brought to market. Many of the managers people do know, and some of the emerging ones out there as well. What do you attribute some of these trends to, Aga? I'm wondering, and what exactly are you seeing from your side over at Tidal with regard to just how much these types of products are resonating with either their predominantly retail base or their predominantly institutional base?
Taking a quick step back, so passive ETFs remain the largest portion of invested assets, but active strategies continue to dominate new issuance. For example, in the past couple of years, almost 80% of new product launches were all active ETFs. And derivative-based strategies like options overlays and income strategies, generating income through different option strategies are one of the biggest product development trends right now that we see at Tidal, also in the marketplace. New product launches exploded in the past couple of years, and issuers in partnership with Tidals accounted for almost half of that. We currently run one of the largest derivative risk management programs in the US, based on a number of products that we trade and monitor, which basically puts us at the center of the trends. And what we are seeing is that the market is going through overlay everything phase right now, where issuers can take almost any underlying and layer on option strategies for income or hedging. And this includes enhancing income on investments traditionally known for generating income through dividends, for example, as well as spaces where income was not associated with in the past. And income in particular remains the number one, it has been the number one selling point and will remain going into the future, because the demand for yield, especially among retail investors, just does not go away. And during uncertain market conditions, that added benefit of income seems to resonate well with investors.
You know, Mike, there was a point in time, you know, maybe it was 10 years ago, maybe even longer than that at this point, maybe 15, 20, 30 years ago, when if you looked at the investing landscape, you kind of made this, I guess, maybe unofficial link in your mind, psychologically as an investor, that it was the large institutions, right? They were the ones that got into more complicated, kind of structured type strategies that typically had sometimes higher fees, but also the possibility for higher returns. But you had to be a little bit more learned to be able to kind of understand how those processes worked. And conversely, you wanted to go towards more passively index-oriented strategies if you wanted to just find a fire and forget that had low cost. That was more geared towards retail. What exactly then do you attribute the change in shift or thinking about these types of products towards, that we now see most of the larger, big money, real money type investors turning towards some of those more simplistic, lower cost products, yet it's the retail investors that are gearing more towards some of these more complicated features?
Well, I think I'd set it up just a little bit differently in that part of it's just the access vehicle of the ETF changing that dynamic. So as you know, the ETF rule really opened up the floodgates for bringing more derivative type strategies to market. However, I think one of the reasons you're not seeing the adoption rate quite as high with the institutional users is because to a large degree, they were already doing this, right? I mean, writing covered calls is not a new concept. It's not a new strategy. But a lot of your investment advisors are doing that on their own for their clients based on that specific client's needs. But now we're seeing, you know, with the ETF wrapper, a much more efficient way to do it in some respects, especially with synthetic income. However, I would note that it's gotten really kind of the Wild West in terms of what you can do. I mean, if you look at indicated yields or distribution rates for the synthetic income market, you have some that are trading, you know, returning almost 100%, which is really just going to be an erosion of NAV, and others that are much more targeted in specific ranges, whether it's 5 to 8% or 8 to 12%. So there's a lot of education that has to be done before buying any of these products because they're all managed a little bit different. But big picture, I don't think, you know, it's that institutions aren't using it. They have a little bit different ability to access it. So if you're a self-directed investor and you like that idea of being able to generate income off of a more volatile strategy, as well as capture some of the upside, there's a lot of, you know, QQQ type strategies that have covered calls on it now that have done very well and have returned a nice solution for the investor. But a lot of that institutional money had already kind of, they've been doing this, you know, for a while. So it's the ETF wrappers making it so that those self-directed investors can access the same vehicle.
Aga, you know, it's interesting that Mike mentioned kind of this knowledge gap aspect when it comes to kind of understanding how some of these funds and strategies work. From your standpoint over at Tidal, what exactly is it going to take in order for some of those knowledge gaps to kind of maybe shrink a little bit, not just among the investment advisors that people turn towards for their advice in managing their portfolios, but also some of the retail investors that invest in these vehicles directly? What exactly do they have to know about these types of products, some of the ones that have more exotic elements to them, as opposed to buying a straight-up S&P 500 or sector-based ETF?
Mm-hmm. That's a very good question, Dom. So the key takeaway for investors is that there's no free lunch in options income. The more income a strategy produces, the more upside you typically give up. Yield is a product design choice. And there are a lot of different ways to generate that income through option strategies for investors. There are very successful ETF brands out there that generate max income, and there are very successful ETF brands out there that generating a very conservative levels of income. It all depends, you know, who the product has been designed for. As derivative income in particular, or hedge type ETFs get more complex, having a very experienced platform behind the issuers really matters. All the regulatory, operational, trading infrastructure, including highly trained trading desk, and sort of product development expertise to package sophisticated option strategy into the ETF wrapper, and then be able to articulate what the strategy does and what it does not do will be critical.
All right, Aga, to follow up on that, because the Tidal financial platform has become a place where many products are being brought to market, sometimes from investment managers that we know or are familiar with, or from some of the other managers out there who are just kind of getting going with perhaps interesting strategies to be brought to market that just haven't gotten the traction yet. What exactly are you seeing with regard to the fund universe that you either advise or have sub-advisors for? What types of products do you think are gaining the most traction or being brought to market at the fastest pace? What types of products, I guess, in my mind, are being at least deployed on the Tidal platform more readily than others right now?
Because of our experience in derivative trading, our bread and butter are truly derivative-based products. So anything with options, futures, and swaps. So on our platform, we launch a lot of income products, as well as a lot of leverage products. And generally speaking, we have had a lot of successes with thematics. I believe we are able to equip our sponsors with whatever it is that they need in order to bring timely thematic ideas into the marketplace. So I would say derivative-based products as well as thematics.
All right, Mike, what exactly in your mind have you seen in terms of those thematics that are developing for the broader ETF industry overall? What can we expect to see with regard to the, I guess, next leg of ETF launches, the types of demand that we're seeing from investors and traders and investment advisors? Where exactly are we going to see that kind of next move? We saw a boom in crypto for a time being. As of late, it's been precious metals oriented, given the price surges and volatility we've seen in places like gold and silver. What exactly is going to be that next leg for the ETF market? Where's that demand coming from?
So I think one of the great things about the ETF is it's just a wrapper, right? So you're ultimately getting access to the underlying strategy, or generally speaking, the underlying stocks or bonds. So I think that'll be driven by the market. The ETF wrapper is just more efficient for a lot of things, not everything. And I always say I'm an ETF first type of guy, but I'm not an ETF only. And I do think we're seeing examples where certain things like privates and whatnot that are getting thrown into ETFs need to be questioned a little bit. But broadly speaking, I think it's going to be driven by what's going on in the world, right? So we're seeing a rotation of assets year to date, really in the thematic space, kind of from that AI theme to more real asset type thematics, whether it's the infrastructure, whether it's industrial reshoring and things of that nature. So I think the ability to get an ETF to market has become very mainstream. It's super easy if you have the right provider or partner, like with Tidal here, or another firm, to get a product to market. So I think the investor is going to drive that next theme based on the market. Now, of course, there is always that a little bit of performance chasing that goes on, and sometimes by the time the themes get to market, the trade is played out. But there's no reason to think within the ETF space that we're going to run out of innovation, because as macroeconomic landscape changes, as performance leaders and laggards change, I think the market will adapt. And I think the important thing to remember is if you're investing in a large S&P 500 or a manager who has a mandate of owning large cap securities, but with a lower tracking error, that's one thing. If you're investing in these strategies that are niche, that have a narrow focus, the shift goes from the manager, your success goes from relying on the manager to your ability to use the product at the right time. And I think that's a big component to understand. Just because there's a strategy for AI, or there's a strategy for cloud computing, or you name it, whatever it may be, those are tactical strategies, tools to give you an efficient way to allocate to that market. but the onus is on you to decide whether it's a good time to invest in it.
Now, Mike, I'd like to just follow up with a question about what you think is going to be the most intriguing aspect of the ETF market for the balance of 2026. What do you think is going to get you to pay attention to what's developing in terms of not just product, but some of the investment themes and macroeconomic stories that are going to weave their way through 2026?
Yeah, it's a great question. I do think you're seeing the active passive at a high level, with the big firms getting now finally embracing the ETF market. We've seen 250 billion in year-to-date flows. We're on pace to destroy last year's record, which destroyed the years before's record. But part of that is we're getting a big tailwind from the active managers really selling their active ETFs. So year-to-date, $100 billion have flown into big active strategies. Looking underneath the surface, I think we're going to see two trends this year. I think we're going to see a consolidation, of the non-traditional. So I think you're going to start seeing, everybody launched these different strategies for covered calls. Everybody launched these different strategies for buffers. But I think you're going to start seeing a consolidation to those strategies that have performed the best and that have gained a market share. So I think there's going to be a consolidation shift. I think they'll continue to grow and get adoption from investors. But I think that we're going to start seeing some serious winners and losers within that, because we had a little bit of everybody launch something, and you can't have that many strategies tracking the same spot. Within the themes and the sectors, the evidence is showing right now, whether it's a rotation from growth to value, or whether it's a rotation from, unprofitable tech into more natural resources or infrastructure type strategies, that's starting to get some legs. And I think that will continue to the extent that the market continues to play out, where people start questioning the AI trade a little bit, start trading the duration risk on, high growth names. So those are the areas I'm watching the most closely.
All right, Aga, for you, from a product development standpoint, because of Tidal's presence across many different types of ETF strategies and many different types of investment managers who kind of bring these products to market, what exactly has you the most intrigued or excited about the new types of products that you could see coming down the pike for the rest of 2026?
Another very good question. Only because Mike mentioned AI, so we can create a long-only AI type portfolios, providing investors access to the AI theme and sub-themes, but also AI is basically finding its way into investment process. So we have seen already on our platform launches or filings of products that are AI enhanced or AI managed. So this area is very exciting, as we are only scratching the surface. Institutional interest in digital assets, it's still tactical, in my opinion, based on the flows. And as the adoption sort of increases or widely spreads, that should also fuel product innovation around digital assets as new tokens gets approved to be held within the ETF wrapper, and so there will be. I expect a lot of innovation taking place around within digital assets in particular, and then volatility based strategies. Every time volatility spikes in the marketplace, that triggers product innovation. That also changes how the flows are going into equities versus other strategies. Typically, there's more product types that are being launched around, market volatility and stuff like that.
All right, it's a great time for ETF investors and sponsors. It seems like these days the friction to bringing a product to market has really gone very, very narrow and very, very smooth for a lot of folks out there. So thank you very much for the conversation, Mike Akins over at ETF Action, Aga Kuplinska over at Tidal Financial Group. We appreciate it. Now, we've asked Aga to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.